You've looked at the gold chart and thought, I missed it. The run already happened. The train left. You're too late. But what if that feeling is the point? Because while you're sitting there thinking the opportunity passed, the largest financial institutions on the planet are doing something they haven't done in over 50 years, and nobody's talking about it. I'm Finn, your finance buddy, and today I'm not going to tell you to buy gold. I'm not going to tell you to buy anything. I'm going to show you what the smart money, the people who literally create currency, are doing with their own reserves. What you do with that information, that's your call. But if the people who write the rules of money are changing their behavior, maybe it's worth understanding why. Let me tell you when I first noticed this. A few years back, I was doing research for a video about inflation. Boring stuff. Central bank balance sheets, reserve compositions, the kind of spreadsheets that make your eyes glaze over. I almost closed the tab, almost moved on to something else, but then I noticed something weird. Country after country was increasing their gold holdings, not by a little, by a lot. And these weren't small countries, these were major economies, nations with trillion-dollar GDPs, countries that have entire teams of economists and analysts deciding where to put their reserves. At first I thought, okay, maybe it's a coincidence. Maybe a few finance ministers read the same blog post. But then I started digging deeper, and I found the other pattern: repatriation. Countries weren't just buying gold, they were moving it, physically, taking gold they had stored in London, in New York, in Switzerland, and flying it home, under armed guard. We're talking about hundreds of tons of metal being loaded onto military aircraft and transported across oceans. Not in secret, this is public information, but quietly, without fanfare, without press conferences. I sat there looking at these reports thinking, why? Why would a country spend millions of dollars to move gold that was already sitting safely in a vault? If you trust the system, you leave your gold where it is. Vaults in London have been holding other nations' gold for over a century. It's tradition, it's convenient, it's secure. You only move it home if you're worried that one day you might not be able to access it. And that thought kept me up at night.
Now here's where it gets interesting, because
This isn't the first time this has happened. Let me take you back to the 1960s, and I want you to really picture this, not as a history lesson, as a story about real people making real decisions. After World War II, the global economy ran on something called the Bretton Woods system. The idea was simple. The US dollar was pegged to gold at $35 per ounce, and every other currency was pegged to the dollar. It was elegant, it was stable, and for about 20 years, it worked. But by the 60s, cracks started forming. The US was printing a lot of dollars, fighting the Vietnam War, running deficits, funding social programs. The money supply was expanding, and some very smart people in Europe started doing math. They realized something uncomfortable. There were more dollars in circulation than there was gold in Fort Knox to back them. The promise of Bretton Woods was that any country could exchange their dollars for gold at the fixed rate, $35, 1 ounce, guaranteed. But if everyone tried to do it at once, there wasn't enough gold, not even close. So what did they do? They didn't wait. They didn't trust the system to sort itself out. They didn't hope for the best. They started exchanging their dollars for gold. Quietly at first, then not so quietly. France literally sent a naval ship to New York to pick up their gold. Charles de Gaulle made it a national statement. He called the dollar's privilege exorbitant and demanded real metal. The countries that saw the math early, they acted on it. They converted their paper claims into physical gold and brought it home. And they were right. On August 15, 1971, a Sunday night, President Nixon went on television and changed the world. He announced that the United States would no longer honor the gold exchange. The window was closed. Dollars could no longer be converted to gold at any price. The entire global monetary system, the system that had governed international trade for a generation, had to be rebuilt from scratch. Now here's the part that doesn't make it into the history books. Imagine you're a regular person in 1970, a factory worker, a teacher, a small business owner. You've been saving your whole life. You trust the system. You trust the dollar. Then one Sunday night, without warning, the rules change. Your dollars are no longer backed by anything except a promise. And over the next decade, inflation explodes. By 1980, the purchasing power of your savings has been cut in half. You did nothing wrong. You worked hard. You saved. You played by the rules. You just trusted the paper. And when you look at what countries are doing today, it feels familiar. Now, I'm not saying we're heading for the same thing. History doesn't repeat exactly. The system today is different. The dollar isn't pegged to gold anymore. But history does rhyme. And when I see the same behavior, countries accumulating gold, countries moving gold home, countries reducing their dependence on dollar reserves, I pay attention. So why is this happening now, in our lifetime? There are a few theories, and I want to walk you through them honestly, because I'm not here to sell you a narrative. I'm here to help you think. Theory 1. Sanction proofing. In 2022, the world watched Russia get cut off from the global financial system almost overnight. Over $300 billion in foreign reserves, money they held in other countries' banks, were frozen, inaccessible. You can agree or disagree with why it happened. That's politics. I'm not here for that. But every other country on Earth watched it happen, and they all learned the same lesson. If your reserves are in someone else's banking system, they can be frozen with a phone call, with a policy decision, with a keystroke. If your reserves are in gold, sitting in your own vault, in your own country, they can't be. Gold doesn't have a password. Gold doesn't have an off switch. Gold doesn't care about international relations. That's not a political statement. That's just physics. Theory 2. Currency diversification. For decades, the US dollar has been the world's reserve currency. Most international trade is priced in dollars. Most foreign reserves are held in dollars. But that concentration makes some countries uncomfortable. If the dollar weakens, their reserves weaken. If the US makes a monetary policy decision they don't like, they're exposed. Gold is neutral. It's not issued by any government. It doesn't come with foreign policy attached. It doesn't care who's president or what the Federal Reserve decides. For countries that want to reduce their dependence on any single nation's currency, gold is the obvious alternative. Theory 3. Inflation hedging. Central banks watch inflation too. They see the same money printing, the same deficits, the same debt levels that we see. And some of them are quietly hedging their bets, not abandoning paper currency, just diversifying, just making sure they're not all in on one bet. Now, here's where I have to be honest with you. I don't know which theory is right. Maybe it's all three. Maybe it's something else entirely that we won't understand until later. But I know this, when the people who manage national economies start behaving differently, it's worth noticing. But here's what drives me crazy. Turn on financial media. Read the mainstream articles. Listen to the talking heads. What do they tell you about gold? It's a relic. It doesn't pay dividends. It just sits there. Stocks outperform over the long run. Gold is for doomers and preppers. That's the message for retail investors, for regular people, for you and me. And look, some of that is true. Gold doesn't pay dividends. It doesn't generate earnings. Over certain time periods, stocks absolutely do outperform. But here's what bothers me. Look at what central banks actually do with their own money. Not what they say, what they do. They're not buying crypto. They're not buying meme stocks. They're not putting their reserves into index funds. They're buying gold. More gold than they've bought in 50 years. And they're physically moving it to their own soil. These are the same institutions that tell you the system is stable, that tell you to trust the dollar, that tell you gold is outdated. And yet, they're stockpiling it. There's a name for this. It's called do as I say, not as I do. I'm not saying there's a conspiracy. I'm not saying anyone is lying to you on purpose. Central banks have complex reasons for their decisions, reasons that don't always apply to regular people. But I am saying this: pay attention to actions, not words. If the entities that create money, that set interest rates, that manage national reserves, if they're diversifying into hard assets, maybe that's information worth having. Maybe the question isn't, should I listen to what they say? Maybe the question is, should I watch what they do? Okay, so central banks are buying gold. Central banks are moving gold home. We've established the pattern, but you're not a central bank. You're a person with a checking account, and maybe a little bit in a brokerage app. What does any of this have to do with you? Here's my honest take. This video is not me telling you to go buy gold. I'm not a financial advisor. I don't know your situation. I don't know your goals. I don't know your risk tolerance. And frankly, if you came to a YouTube video for specific investment advice, we need to have a different conversation. But here's what I will say. Most people build their entire financial lives in one currency. They earn in dollars. They save in dollars. They invest in dollar-denominated assets. Their stocks are priced in dollars. Their bonds are priced in dollars. Their savings account is in dollars. Their whole net worth is one bet. And for most of history, that's been fine. The dollar has been strong. The system has been stable. If you're American, it made sense to be all in on America. But the people who manage trillions of dollars, the central banks, the sovereign wealth funds, the institutions, they don't make that bet. They diversify. They hold multiple currencies. They hold gold. They hold real assets. They spread their risk across different scenarios. They're not doing that because they're paranoid. They're doing it because diversification is just good risk management. It's boring. It's basic. It's what any competent financial manager does. So the question isn't, should I buy gold? The question is, am I diversified? Or is my entire financial life one concentrated bet on one system staying stable forever? Let me give you some math that made me uncomfortable. If you had saved $10,000 in 1971, the year Nixon closed the gold window, and just held it in cash, by 2024, you'd still have $10,000. Same number on the paper. But that $10,000 would only buy you about $1,200 worth of stuff compared to 1971. You didn't lose money, you lost purchasing power. Same thing, harder to see. Holding one asset in one currency for decades has risks, even if that asset feels safe. The central banks understand this. That's why they diversify. I'm not going to tell you what percentage of my portfolio is in hard assets. That's my business. And honestly, it changes. I'm not static. But I will tell you this. I ask myself one question every year. If everything I believe about the economy turned out to be wrong, would I be okay? If the stock market crashed 50% and stayed down for a decade, would I survive? If inflation spiked and stayed high for years, would my savings hold up? If the dollar weakened significantly against other currencies, would I still be able to live my life? If the answer is no, I'm not diversified enough. That's it. That's the whole framework. It's not about predicting the future. It's about being prepared for multiple futures. The central banks can't predict the future either. They don't know what's coming, but they're preparing anyway. That's not fear, that's wisdom. All right, let me give you something concrete to walk away with. Here's how to turn all of this into something practical. I call this the watch what they do, not what they say framework. Step 1. Ignore the headlines. Financial media exists to generate clicks. Gold is going to the moon. Gold is a terrible investment. The dollar is doomed. The dollar is stronger than ever. It's noise. It's designed to get you emotional, to get you clicking, to get you watching ads. Tune it out. Step 2. Watch institutional behavior. Central banks file reports. Sovereign wealth funds disclose holdings. This information is public. It's boring. It's buried in PDFs that nobody reads. But it tells you what the big players are actually doing with real money, not what some analyst thinks might happen. Actions over words, always. Step 3. Ask yourself the diversification question. If one thing went wrong, if the currency you hold weakened significantly, if the market you're invested in dropped 50%, if inflation stayed high for a decade, what would happen to your net worth? If the answer is, everything would be fine because I'm diversified across different assets, different currencies, different scenarios. Great, you're ahead of most people. If the answer is, I'd be in serious trouble, maybe that's worth thinking about. Step 4. Make your own decision. I'm not here to tell you what to buy. I'm not here to scare you. I'm not here to sell you gold or anything else. I'm here to make sure you're asking the right questions. The right question isn't, is gold going up or down? The right question is, am I building a financial life that can survive more than one scenario? Let me leave you with this. The average person thinks about money in terms of income and expenses. Earn more, spend less, save the difference. That's level 1 thinking. And it's not wrong, it's just incomplete. Level 2 thinking is about systems, automation, compound interest, building machines that work for you. Level 3 thinking is about resilience, diversification, understanding that the future is uncertain, and building a financial life that doesn't depend on everything going perfectly. The central banks are level 3 thinkers. They're not predicting the future, they're preparing for multiple futures. You can do the same, not by copying them exactly. You're not managing a national economy, but by adopting the same mindset. Don't bet everything on one outcome. Don't assume the system that worked yesterday will work tomorrow. Pay attention to what the big players do, not just what they say. That's not financial advice, that's just common sense. I want to hear from you. In the comments, tell me, what percentage of your net worth is in hard assets versus paper assets? Be honest, no judgment. I'm curious where everyone's at. And if you want to understand how I personally think about portfolio construction, including how I balance growth assets with stability assets, that's coming in a future video, so make sure you're subscribed. Also, if you want me to break down exactly how I track central bank reports, where to find them, what to look for, let me know in the comments. If enough people want it, I'll make it. I'm Finn, your finance buddy. The game is always changing. The players who pay attention are the ones who win. Stay curious, stay sharp. Cheers.